Um, Neil, where are you sitting? Neil Fong?
I'm in Singapore with Rob.
That's right. Excellent. So look, we'll get started. I'm just going to turn this annoying music that comes on from time to time that tells people that are coming in and out.
Turn it off.
Okay, beautiful. Thanks. And this is always a step ahead. So this is just the hour, as we do it every month. You've done it with us. We go around. The theme this month is, I was telling Rich Sobel today, what do you want me to talk about? Just, a unique insight that hopefully someone else doesn't know. You've got a vantage point on. I know that Greg, it says risk on, but that was from an earlier conversation, but he has a particular take. I'm going to let him kick off. And again, if you go, so we have enough time, I want to try to get everybody through within like 30 to 40 minutes, and then we'll open it up, Q&A. And then at 11, if you want to stick around, 10:30 is our weekly town hall. 11 is our weekly briefing, but it's turned into our conference. And then at 12, they'll have some breakouts. It'll be a breakout about 5 subject areas. We'll tell you about those later. And then day 2, actually, this is day 2 on the screen. Day 2 is when 8 o'clock tomorrow. So back to you, Greg, to kick us off.
Yeah, Mark, thanks. And hello, everyone. Now, I think thematically, I think risk on, which is the characterization you had for me, Mark, is right. But I think it's for us, it's a theme that we've been playing for about 3 months now, and I think it has a lot of legs left. And I think it's the cyclical rotation from growth into cyclicals, and specifically an area that we like a lot is recovery stocks. And you see days like yesterday where some of the recovery names we're playing are Hawaiian Airlines. That was up, I think, 9% yesterday. So, and I think that stock has a long ways to go. When you think it's this rotation that we're going to see, that as we come out of COVID, we're very focused on airlines that are domestically centric and leisure oriented. And you think of Hawaiian Airlines by definition is one of those stocks. We like leisure REITs a lot. Carnival Cruise Lines is another great stock that's moved a lot in the last 2 months. And I think we are finally starting to see the breakdown in tech. I mean, we saw them move in Tesla yesterday, pre-market today, it's down another 7%. We're seeing Snowflake break down, we're seeing Unity break down. So finally, I think we are seeing the rotation sanity return back into the market, and we're seeing a rotation. Financials, we've seen a huge move in those. Obviously, JP Morgan's up a lot in the last 2 weeks. And so I think for us generally, a theme that we really believe a lot in over the next 12 months is this rotation out of growth. And I won't generically say value broadly, but I think financial services do look attractive. Energy is looking pretty attractive here with oil above $60. So I think the risk on theme for us is putting money to work in value-oriented things that'll have significant earnings momentum coming out of COVID.
Great. I didn't even have to put my yellow light on, Greg.
No.
Any quick question then, since you left time?
Greg, what do you think about rotation from large to small?
Yeah, I think, I do think what we've seen in small, in my opinion, is an expression of the growth momentum that we've seen. So I'm not sure small cap's going to be able to hold up, but I think I do believe that this sector theme in small cap holds as well. But I do think there is going to be a meaningful rotation out of a lot of these high momentum stocks into more value oriented things. So Todd, I think probably small cap value will probably hold up.
Yeah. Hey Greg, this is Rob. What about the return to normal or the hybrid normal? Are there any sectors in particular that you're feeling has peaked out and you guys are considering some exits?
We still like airlines here, for example. The cruise lines, I think you could debate whether their capital structure is overly leveraged at this point. So, if there's one area that we're probably a little more worried than most, it probably would be cruise lines because of all the debt they took on. But we still like airlines a lot. I actually think we're still in the very early stages of the leisure REITs. I think those have a good amount of legs to go. But probably to answer your question, probably cruise lines probably worries us the most at this point.
We're gonna keep it moving. Bill Deukler, I'm gonna yield the floor to you and the screen.
Okay, very good.
Unless you want me to, I have your slides if you like.
Yeah, why don't you go ahead if you would, please.
All right, go back. 1 second. Why don't you kick it off while I'm pulling it up here?
Sure. So yeah, this morning I'll kind of switch hats from my CIO at the single family office to trustee at a small municipal pension plan here in town. And you know, we have no staff. We do have a consultant. So essentially the board, you know, acts in conjunction, you know, with the consultant as CIO, and we're having to make decisions about the portfolio. You know, clearly one that has been, you know, a difficult one that we've all kind of talked about is sort of the whole situation with fixed income. Mark, if you want to go to the second page 2.
This one?
Let's see. I am.
We were arguably at the end of the longest rally in bonds.
Yeah. Yes. So yeah, I'm sorry. I'm having to orient. I'm seeing both pages. So yeah, you know, yesterday the 10-year printed, I think, at 136. So even though we've got a little bit of a rise going on, we're still like way down on the yield spectrum. And if you want to go to the next page.
Yep. Scattergraph.
Yes. Okay. It's not showing up on my screen.
How about you guys? Can you see this?
Yeah, I can see it.
It's the best forecast of future bond returns and current yield.
Okay, this is great. It's like the speaker's blacked out, so it's a good test. Here we go.
Yep.
Anyway, so here this chart is a little bit old, but I think the data is pretty solid from Research Associates. You know, your best forecast for bond returns is the current yield to maturity, and we're way down in the left-hand corner there. So the likelihood of fixed income, you know, producing over the next couple of years is going to be really, really tough. So the question is, you know, well, yeah, you want to flip to the next page real quick?
Sure. Impact of rising rates.
Right. So, you know, again, this is kind of no news to all of you, but clearly kind of where we are, if you've got any kind of duration in your portfolio, you know, rising rates is going to be detrimental to that. And this is just an example of some of the numbers that were run a little while ago. So we're really kind of between a rock and a hard place fixed income wise. And going to the next page. So what's the conversation, you know, that I need to have with you know, with my consultant? And, you know, let's put our heads together. Let's see if we can figure out something that's a little bit different, looking at strategies that, you know, as I note here, kind of preserve the effect and diversification of fixed income, but don't have the risk exposure to traditional fixed income. And, you know, we need to look underneath rocks, ideally trying to find risks that are orthogonal to the major risk factors, ideally both equity as well as fixed income. And if you want to go to the next page, so, you know, kind of looking around, and I've been at this for a little while, and I'm hoping to have this conversation with my consultant next week. You know, looking at direct lending, but small niche direct lending, you know, infrastructure, different types of arbitrage and relative value, which, you know, Sherry, I would love to talk to you sometime about some of the guys that you might be looking at. Different takes, not traditional real estate, but different takes on real estate, you know, could be it. And going to the next page, the idea about building out this side of the portfolio is going to be very focused on tailoring the return distribution, trying to center the return, the mean of that distribution as close to what we can get to a fixed income like, you know, traditional fixed income like return, and at the same time using the diversification of a portfolio of several managers to push those tails in so that we can mitigate, obviously the left-hand side without too much trade-off on the right-hand side.
So I see you have more slides. I'm moving along. Sorry.
Yep, no, that's good. Okay, so is it possible? And I just wanted to throw up some numbers here. This is some older data where I looked at this a little bit while ago. And just in terms of potential magnitude, there is possibility. There is a possibility of excess returns over the ag, lower standard deviation, high, and a good Sharpe ratio. Next page. One of the interesting data points, out of this test was that it is possible to get low correlation internally, from a portfolio of truly diversified managers. And you can see here that on this test, the internal correlation was basically 0 and very low correlation to the aggregate bond index.
I'm on the last slide.
Yep. So there we go. So here's the conversation that we're going to have to try to find, managers that will adhere to the type of characteristics that we're looking for. And hopefully we're going to be able to get something done with our consultant. We'll see. I like the last quote from Michael Porter: strategy is about making choices, trade-offs. It's about deliberately choosing to be different. And I think that's what we have to do in this particular asset class going forward. So thank you very much.
Okay, we're going to switch over to you, Anders, since you're the next slide. I'm passing the baton. You got to make up the time.
Yep.
You're on mute.
Apologies.
No, you're good. You're awesome. You're awesome, Bill. We'll talk about that.
So this is going to be a bit tongue-in-cheek, but given that the time constraint was 3 minutes, I figured I'd manage myself to 1 remark per line. If you close your, yeah, exactly. Next slide, if you will. I just want to raise a point. This is not really a 2021 topic, but we spend so much time in the granularities of, a detailed correlation analysis that I think there's one big opportunity left. If we build portfolios around causal risks, we spend the time not to worry about in the first step, the expected returns, and try to build a portfolio that relies on truly differentiated risks. So to Deutschler's point, if you have a B2B or direct lending circumstance that gives you, stand still for a second, that relies on a risk unique to that particular business-to-business lending scenario, then talking about it as fixed income is almost irrelevant. You're probably having a risk on a receivable in a particular business space, and then you can talk about decorrelation. Here's the hidden risk. We all know this, but the one I think we accept that it's there and we move on because it's so too hard to figure it out. Take this portfolio of just a random allocation between some common buckets. If you hop to the next one, Mark. What I'm proposing is that across these, I'm calling it GCM, GDP, cyclicality, and macro. That's pretty much what you're going to get from your equity allocation in entirety, forgetting now about alpha and active management. In your high yield portfolio, it's going to be by and large dominated by the same, and so on and so forth. Your fixed income portfolio may be uncorrelated, but it's still driven by the same factors. So a generic portfolio that is over diversified, the point I'm making is we talk about diversification being a free lunch, but a over diversified portfolio is going to give you that broad market beta that we at the same time strive to move away from. So as an idea for 2021, I am working with the clients I deal with, which is to try to isolate and identify what the actual risks are. This thing will fail if water prices drop, if the snowpack disappears, if non-performing loans break, things that don't rely. I could see a print down 20% on the S&P without necessarily knowing there's any causal change to my portfolio. So essentially pinning the actual risks rather than the mathematical correlations, I think is sort of where there's a lot of opportunity for value. That's it.
Thanks, Anders. While it's fresh in mind, anything from Bill and Anders people have questions on? If not, then I'm just going to pick on Sherry. You hearing some of this, but your own views, your insights. Good to see you again.
Hi, Mark. Thank you so much for having me. Good to see everyone. So very gratefully, we've had probably my best performing year last year, 2020. And then so far for 2021, I've already netted more than in multiple years combined. What's been great about the silver lining to the situation is I've taken a hard look at my managers. And I think that one of the things I've learned is I can go back to the same trader or manager, but in a different strategy. So anyone that I made money with maybe 10 years ago, when I started the family office in 2011, or 8 years ago, that particular trade may have gone away, but that trader who was so great at shorting fraudulent Chinese companies or doing something else has found another opportunity. So that's been great. It's been, the liquid part has been so rewarding for us that we're also, I hired someone just to do crypto. I hired someone to do illiquid. So the Witter family offices have moved from 57 in Lex to Madison, and we're opening offices in Austin, and we're doing illiquids, and it's not, Mark knows it's not my forte. So, but we're doing illiquids in a more unique way. A lot of people have been showing, so I actually, for opportunities, I probably see 10 illiquid opportunities for every one liquid. And I felt like we were passing up on a lot of things. And I see there was, so what we've been doing for illiquids is hybrids where we're making money on the underlying, but there's still operational cash being thrown off, because I've always had an aversion to being completely illiquid, and it's just moved like molasses for me. So we have found a way to do illiquids where it moves much more quickly. I've been grateful for a lot of the opportunities we're seeing. Many family offices have reached out to us, and we're trying to decipher, because every family office is different. We're trying to decipher if the family office is showing us an investment opportunity as an additional revenue stream, or if it's truly a great opportunity where everyone will make more if you amass greater assets and investments. I see the yellow light, so anyone can feel free to ask me questions.
I just wanted to talk about getting deal flow and organizing it. What we're doing is having everyone go through this onboard, not everybody, but people can, and you fill out this form, and there's a public version, which this is, that we're making available. And then we're doing a big boy room, big boy letter of signings that you have a more full access. These are deals that we don't bank necessarily, so just we're trying to feed the deal hungry dragons. Let me pull back into this.
Hey, Mark, I have a quick question and then a quick suggestion for you. To be inclusive, we should call it big person, not big boy.
It's actually big boy, big girl. But we could call it big person for other reasons, as you.
Who wants to be called a big girl?
And then Sherry, this is Rob Colorino. My quick question to you is, what's your approach? You mentioned liquid and illiquids. What's your approach on SPACs nowadays?
So I have been looking for a SPAC trader, and I've got someone great. So I have to tell you, some of my guys that I've worked with before, I had a debt guy who came to me with an amazing SPAC trader. I also have a SPAC trader within one of these investments groups I belong to. The returns are okay. I'm doing in the 20s. I frankly am doing much better in the crypto space. But SPACs are very interesting, and I trade in and out of them, and I have done probably 2 specific SPACs. But that's always because I have a relationship. So I examine my relation. If it's a very good relationship, I can, I have more confidence in it. And then if it's come through a not so great relationship, I tend to hesitate. But SPACs have been interesting for trading. And I've got 2 guys who, feel free to ping me later. I'd be happy to recommend them to you.
Great.
Thanks.
Thanks. Let's switch over. Anna, I see you on one of my screens here. There you are. How are you? You're on mute though. Get the yellow light off.
Hi, Mark.
Hi. What's your insight today?
Yeah, very interesting what everybody else is doing. So great insights. Thank you, Mark, again for this assembly. No, I think the question on everybody's mind right now is inflation and no inflation. And I think that's kind of, what investors are trying to figure out. I think economists are hesitant to proclaim that we're heading into inflation just because given the, the last 10 years when the increase in money supply has not materialized into high velocity, and so inflation was low. So I think right now we are, we have a lot of optionality against inflation, and investors can take, both sides of the story. The long dated, for example, the long dated options on the long dated put options on, treasury bonds would be a play against, would be a play on higher yields, high long-term yields, so therefore, high inflation. Those are relatively cheap right now. At the same time, last time I mentioned utilities, I think, utilities are a play on low inflation. Now they have come down on expectations of inflation very substantially. So that's kind of the other side of the story. They're now a value play. And there are a lot of interesting special situations there. So I think, you can go both ways. My forte energy has been ripping, and I think people are probably underestimating where oil prices are going to go, just because there has been a huge supply disruption. And I think that we are not yet quantifying how much it has been. So, since everything has been up in the sector so much, I do think there's a way, there is, room to go. But I think that some of the, strong assets which were near bankruptcy, with screwed up capital structures which haven't gone bankrupt, are going to be lifted out of this, with oil prices lifted out of the water. And I think they will deliver good returns. Some of my other deals, I mentioned last time undervalued precious metals. I have been long platinum for a while, and that I think, although it is a play on internal combustion engines, it's been the substitution is palladium, because palladium is so much more expensive. It's just it's both a cheap metal and it's a play on this whole commodities / inflation story. So that's done well. I think it has room to go. And
so let's, you got more insights, Anna. We'll pause on that for now.
Okay.
That's awesome.
Thanks.
Although I would like your curve on oil maybe later. Let's go to Todd Rupert. You've got some slides that you want to share, so I'll stop sharing.
Oops. Yeah, let me share my screen here. Can you see that?
Yep.
So I just want to talk about venture secondaries, which is a unique asset class. There's three types of secondaries, excuse me, three types of venture secondary transactions. First, there's LP interests, where the secondary buyer is buying in individuals remaining pro rata interest in a fund from an investor that either needs the liquidity or has strategically determined that they want to deploy the capital elsewhere. You see this from pension funds and endowments and family offices. The second is GP-led restructurings, or liquidity solutions where the secondary buyer buys across the entire limited partner base, not just from one individual LP. It's a structured process that across the entire fund, enabling the GP to restructure and extend the life of the fund. The third is direct company, where the secondary buyer is buying directly from the cap table of the company by buying stakes from current investors, either current employees or retired, departed employees, angel investors, or earlier stage investors, where they're looking for some liquidity. You know, all in all, it's an attractive approach to venture capital investing. You're investing at a discount, which I'll get to. You get more rapid return of cash than early stage, and you have the opportunity for good multiple appreciation. You know, also, if an investor has exposure to PE buyout secondaries, they're typically buying a very diversified portfolio of funds, and venture secondaries with their differentiated characteristics are a nice diversifier. Just to make a comment on GP-led restructurings, it's rare where you can find a transaction that's a win for all parties involved. The GP restructuring allows that. The way it works is that a secondary buyer comes in through the GP and offers a discount to all of the limited partners. They can either take their money or they can leave it in, or there's a 50-50 option where they can sell some and they can keep some. For the LP that's been in the fund, say 10 or 12 years, they get a liquidity option. For the GP, they're no longer pressured to sell great assets and close the fund because they're in at the end of their legal life. And then they also get some regreened economics and a small amount of new capital to support the remaining portfolio companies. So it's really a win for everybody. Here's looking at VC secondaries in an overall portfolio. VC secondaries have a higher return, higher multiple than you get in other secondaries. And you also get a great improvement in the J-curve effect. And also, VC secondaries typically don't have any financial engineering or hanky-panky, which you might get in most of the private equity buyout secondaries. And because of the attractiveness of this, we're seeing a lot of increased institutional allocator interest in the asset class. We've also seen a lot more interest among folks that had no prior venture capital exposure, but now they're coming into this area because they're getting their money back more rapidly. This is data from Greenhill, which is a secondaries broker. And you can see that over time, there has been a very significant differential between the discounts private equity buyouts have and the discounts you're getting in venture capital secondaries. Why is that? Well, venture capital secondaries are filled with a lot of inefficiencies. First, the secondaries are more difficult to diligence and underwrite. GPs and direct companies don't like to share information, especially granular company-related information. Companies in a venture fund are less mature than those in a buyout fund, and many are not yet profitable, so they face more uncertainty. Typical analytical metrics used to evaluate a buyout LP are different than and maybe not valuable. And these issues are compounded by the fact that there can be restrictions on who can buy. There can be blocking rights by the GP and rights of first refusal offered to existing LPs. And for that reason, you don't have as many brokers involved, and so there's much more limited set of buyers compared to a PE buyout secondary. So this creates a real tremendous buying opportunity if you're a firm that's a large primary investor in funds and you've developed deep relationships with them. Now, let's look at how the growth drivers for the venture secondary market. In the upper left-hand box, first and foremost, is the increasing time to liquidity. You know, now you're seeing 8+ years to an IPO, and it's increasing. So companies are staying private longer, and they're building to a larger size, a larger scale, and more valuable. And part of the reason for that is that there's more patient capital out there to allow them to be private longer. There's less pressure to gain that liquidity. And at the LP level, in the upper right-hand corner, you can see that 73% of the funds in the marketplace today have been around for 13 years. And LPs will get pretty tired in looking for some liquidity of that time. And the most interesting thing about all of this is that when venture funds are high single digit or low double digits, they've got some very attractive companies in their portfolio. Typically 80 to 90% of the NAV is made up of only a few companies. All of the losers are already gone. So it's a great opportunity to buy at a significant discount to NAV, a concentrated portfolio of good companies that are a few years from liquidity.
Todd, just to give you a little warning, I see 11 slides.
Boom, here we are. Well, let me just, here's where we think the market will go. Right now, if you take a look at all of the Series B and further back to VC-backed company has a $1.1 trillion. And if we assume 5% secondary transaction, that's $60 billion in 2021. Fast forward 5 years, we think that's a 3x. So when you combine together the directs, the LP interest, and the GP restructurings, it's a big market. And it's a very attractive place to invest. So I'll leave it at that.
Excellent. Any questions to Todd? I know a lot of people are active, including in GP-led. We'll come back to that. Let's see, who else we have left? We've touched everybody. I know Eric in Lindbergh is in Texas and finding it difficult both from weather and connectivity. So I think we might have gone around the houses. So let's open it up. Unless I missed anyone, I think we got everybody. What do people think of those ideas, those insights, or maybe share your own? And actually, since Anders, another person that you sort of reintroduced to me, Daniel Gottlieb, maybe just by way of you want to introduce him into the group, or maybe Daniel yourself.
Sure, I can talk for myself. Good morning, everyone. My name is Daniel Gottlieb. I was the CIO of a family office outside of Chicago for about 10 years. 5 years ago, moved out to Colorado, where I manage an institutional portfolio for the Southern Ute Indian tribe. So it's a slower moving thing than what I think a lot of the ideas that some of you have talked about this morning, but it's really interesting to sort of reconnect with the family office world and with this group.
You want to couple that with an insight, or you want to play it passive today?
You know, I mean, it's pretty early because I'm in Colorado, so I maybe woke up on the wrong side of the bed. I mean, one of the things that I've been thinking about a lot over the last few days, because we've actually been seeing the impact of it here locally, has been the narrative around the vaccines and what happens when people realize how many people actually aren't going to take them in this country. Because like I said, we're seeing it here now in terms of local distribution and availability. And on the one hand, it's great for availability, but I think that when I look at the journal and places like that, all I'm hearing about is the mad rush to get vaccines. And I think that we're overlooking a really large portion of the population that at least right now is still very reticent. And so I do worry about some of the projections and the thought process around Q3 and Q4 and quote unquote reopening and getting back to normal. And I'm not an epidemiologist, obviously, so I need to sort of get smarter around what it actually looks like if we have a population that ultimately settles out at 50 or 60% vaccinated, because locally, I think that's our best case scenario here.
Anyone with a comment on that?
What that means for the portfolio, honestly, is just that to the extent that I'm thinking about long equity beta, I want to have more stuff with long short managers as opposed to long only. That's sort of like my super glib way of dealing with that.
Mm-hmm. Hey, Daniel, that's interesting what you're saying. If you don't mind us asking, is that commentary, is that related to the tribe or is the community you're in, is it more urban or is it more rural?
So it's rural. I live in Durango, Colorado, which is near the Four Corners. The population of my county is about 50,000 people. Politically, it's actually sort of purple verging on blue. So I don't think this is purely like a red rural phenomenon. But it's not just limited to the tribe. It's more sort of just the region in general. And again, it's early, it's largely anecdotal. But I just know that the tenor around here regarding vaccine availability is very different from what I'm hearing from my friends in Chicago and New York and San Francisco and places like that. And I do wonder what happens when all of a sudden there isn't a mad rush for this, and we realize that there still is, again, whatever that number ends up being, of the population that just don't want to do this.
Mm-hmm.
I think it's a very interesting thought. This is on, and I just wanted to, give a kind of a on the spot kind of extension of that. I think when I came to the U.S., I'm originally from India and I lived in Europe for a number of years. But when I came here, I was shocked at how many people had never left their kind of hometown, home state. It just was alien to me, because as an immigrant, I was moving around. So I can definitely see a future. This is global, I would say, not just in the U.S., where a large percentage of the population is not vaccinated, but also doesn't move around much in terms of daily activity and stays in their communities. And then the international contingent, which moves around a lot. I mean, I'm looking forward to getting fully vaccinated so I can travel and visit, places and folks and all that. And I think even in countries like India, 100% vaccination is, very, very difficult to achieve in anything, including polio and other, diseases. So I think it'll be interesting to see the active population that's interacting with each other. They're going to be the ones to transfer variants. And so therefore, I don't know if vaccines are going to cover some of these variants. So I'm flashing on the screen the calendar. I don't have the virus update number 5 for Bill Deukler that he put together, but that would be one of the phenomena we should touch on, Bill, in the next, I don't know when you're going to schedule, I think the end of April.
Yeah, probably end of April or beginning of May. I can tell you what we know so far is that both Pfizer and Moderna are or seem to be effective against the UK variant. With regard to Brazil and South Africa, that data is still out. Steve was kind enough to send me the latest curves from IHME, and they flattened out a little bit, but there is still a bump that's showing out in the April, time frame. Mm-hmm. So, we'll kind of see, Dana, your comment with regard to the vaccine reluctance figures into that little bump. It's a little bit worse if we go to the worst case scenario and there's sort of more massive vaccine reticence. And, that bump is still out there in April. But nonetheless, the overall general decline trend is still there. And they're showing things, like around June should be, pretty darn good, if their projections are correct.
Well, maybe we can pose this question between events, and maybe he could give us a comment. We can publish it for everybody.
Yeah.
Or the group. Let me just switch to Asia. It's going to be our topic tomorrow, but Rob Garrett, who's sitting in Singapore, and I have promised to start at 7 a.m. after this month. So Rob, you brought some guests. Would you like to introduce them?
Sure. I asked Neil Fong, who works with Cinemas Group in Indonesia, one of the largest conglomerates in Indonesia, to join. I hope he's still on the line. Otherwise, this will be embarrassing. And Hyuk Tae Kwon, who manages money on behalf of a bunch of Korean families, investing both in liquid strategies and primarily in early stage venture in Southeast Asia, to join. And yeah, keen to get their insights. I mean, just from my side, I mean, picking up on that discussion about COVID and the vaccine rollout, I agree. A couple of the strategies that we're heavily focused on revolve around healthcare, and I think that's a big theme thematically in Asia. Lots of Asian investors keen to look at US healthcare at the moment, and bridging stuff into Asia. And I think that, in terms of travel, I mean, sitting in Singapore, we've been stuck on a small island for around 20 months now and unable to leave. And whilst domestic travel seems to be vibrant. And it was interesting to hear the insights of Greg on domestic airlines and cruise lines. I mean, it's vibrant in Australia. I know that domestic airlines have picked up, and I you know, in spite of the United engine scare the other day, I see that domestic travel in the US is pretty resilient. But here, you know, international long-haul airlines, which is the preserve of getting into and out of Singapore, I still think there's going to be a lot of shocks there. And I'm not expecting travel to pick up in a big way for a while. Keep having calls with people in the US who say, hey, we'll see you in September in Singapore. And I kind of chuckle to myself because I don't think it's going to happen. But I mean, Neil's been here and perhaps can give some insights on like what Indonesians traveling into Singapore are saying, and Hyuk Tae from the Korean perspective as well, if he's still on.
Thanks, Rob. This is Neil Fong. You know, thanks for the introduction and the invite. Just one observation is that, you know, the numbers obviously in Indonesia are not really reflective of the situation on the ground. You know, our intel, and I'm sitting in Singapore, so I'm not exposed to the underground situation, but the intel is that, you know, the numbers are significantly higher, you know, probably 5 to even 10 times order of magnitude, you know, and Indonesia being obviously the most populous country in this region, that's a problem, right? You know, in terms of the vaccine rollout, I think it's even more bizarre at the moment because, you know, while everyone else has kind of focused on you know, the more high risk groups, you know, I think it's 65 and over. Indonesia has a different strategy whereby they're actually vaccinating the young people first, because their view is that, you know, the old people aren't moving around anyway. The young people are the ones that are infecting everyone else. So let's vaccinate them first. You know, we don't know if that's going to work out or not, but we'll see. Right. So, you know, the containment strategy has absolutely failed. You know, the data is absolutely wrong. And, you know, at least within the region, you've seen borders completely closed, right, Rob? You know, Thailand's completely closed, Vietnam's completely closed. Same for Taiwan and even the Philippines, right? And their numbers are slightly, well, significantly better, I would say. And we're going to have to see, you know, how their vaccine rollout is going to be accomplished. You know, my understanding is that they don't have the necessary supply at the moment, and given the nature of, I guess, the administrations in these countries, it's very much a pay-to-play type situation where, you know, the top 5% or the people who have the networks and the connections are getting it first. So we'll see. From an investing standpoint, you know, our group has operating businesses in, you know, manufacturing, mining, financial services, telco, and real estate. But where we are deploying capital, or at least looking to deploy capital, is really in areas where we've seen strong resilience. So things like, you know, gaming, media and entertainment, financial services, obviously, specifically within the payment space. There are a lot of, I think, new business models in the region, you know, things like buy now, pay later, which obviously has been, you know, going on in the States for some time. But these are things that we are looking at, preferably slightly later stage. So we tend to invest Series B onwards, but we are tracking some of these earlier opportunities as well.
So Neil, we'll hopefully hear more from you if you can join that discussion with Rob tomorrow at 8.
I will try. If not, we'll get someone else on the team to represent. Okay,
great. And Rob, I do want to switch to a few other people, but you want to put any, Hyuk Tae, do you want to make a comment as well?
Yeah, great to connect everyone. My name is Hyuk Tae, and I'm the founder and CEO of Pine Venture Partners. We're a multifamily office based out of Singapore, manage South Korean money as well as Hong Kong and Singapore family offices. And we go from early stage to the later stage and do a fair bit of venture secondaries as well that Todd mentioned out of Asia. So we've invested into notable late stage deals like DD Chuxing, which is planning to go IPO, DJI, which is one of the largest consumer drone companies. I've also done a fair bit of South Korean late stage deals, early and late stage deals like you guys may know Ping Pong Baby Shark, which is a very well-known short form kids content that has been very popular around the world. I was an early stage investor and I helped the team to Google Global. So my focus really is on finding startups that can scale beyond their home country, mostly Asian tech or Asian founders that are doing interesting things. I've also have invested into another a software analytics company that have moved from South Korea to Europe, and now they're in all the major football leagues in Europe. And yeah, what I see in Asia right now is that many of the Asian countries that we invest in, which is South Korea, Greater China, and Singapore, have done quite well with this COVID pandemic. And there are cases, but it's quite well managed. And a lot of the tech companies that have withered through this stress test are coming out with even better results, better numbers, and new innovative ways to generate revenue, creative business models. So yeah, I'm very excited for 2021.
Great, thanks. And we'll hopefully see you tomorrow as well.
Yep.
I remember when I was interviewing Rob Garrett, Greg came on, or vice versa, and it turned out that Greg, you seem to know everybody in Singapore, even from Pittsburgh. Is that fair?
A few people in Singapore, and Rob's been a great, another great contact there, and so he's been great introducing us to a number of people there. So, thanks, Rob.
Pleasure.
Super. There's some other people. But speaking of Asia, I know that I usually make you stay up until 1 o'clock in the morning. Many of you, so I'm trying to change it. But Doug Van, you've always what's your view of the world today, sitting in Hong Kong?
I think pretty much the same as everywhere else. The Hong Kong is closed, and Hong Kong is dealing with mild cases, I would say, even though the government is really worried about the cases increasing. The number one thing that they want to do is to reopen up with China, and China being singled out a little bit by the US. But having said that, they've done tremendously in the exports last year. And China wants to continue to use Hong Kong as a window for the fundraising, for everything else. And I think opportunities are here are basically in every industry you want to go to, it's there. But the playing field is very much of a mainland Chinese one. In other words, the money is from China, the technology is from China, and then Hong Kong people don't really stand much of a chance, in my view, to compete with the Chinese in China, unless you have a really unique product or unique process. But Hong Kong will always be for the time being, will be the window, the door to the rest of the world, and that seems to be the future. And I would say China will continue to grow because they've decided that, and it's been away for a while already, is that the growth is going to be from domestic consumption rather than exports, which is good. And they've made good inroads, and they're continuing to invest and build. So I would say 21, if they do achieve 6-7% growth rate, that's going to be tremendous for China.
Gotcha. Another switching gears a little bit, unless anybody wants to, has Sean Lawless. I'd asked you about your best ideas. Do you want to share that?
Sure. Do you have the?
Oh no, I don't. Can I let you do that, or do you want me to find it? I don't know if I've got it.
Let me see if I can pull it up for you.
And meanwhile, if anyone else, just curious, Brian, it's been great to see you. Brian Geister, you were on our panel and in one of the worst environments at the Roosevelt Hotel. The next day was the Harvard Club. But you were, how are you, before Sean starts, how are you seeing the world today?
Yeah, absolutely. Great to be here. I'm in Park City, and so for the winter, my fiance and me, and it's interesting as the discussion came up around COVID and people unwilling to take the tests, and I think there's a lot of that. I found a lot of that here, right, from really educated people, so I think there will be implications. But as I've been listening to a lot of different people on the call, there's one theme that I think is just central to investing capital, just like with anything today, and it's as simple as everybody used to go to a lawyer or a doctor, but today you don't go to a general physician and you don't go to a lawyer, you go to a specialist. And so I think one big theme for us is when we're investing capital, either principally where we're making the investment decisions ourselves in companies or real estate or whatever it ultimately is, or individual securities, or whether we're partnering with somebody, it's like, what's their specialization and edge? And I think the more and more that one ends up focusing on that or partnering with folks that have a specialization and edge, the greater advantage and probability of win that you're going to have, right? A number of people here, whether it was Todd Rupert talking about secondaries in Greenspring, or whether speaking about Asian venture, or speaking about, you know, healthcare, or speaking about hiring a SPAC or crypto, you know, trader, for example, those are ultimately specialists. And I think there's lots of people that invest capital as generalists. And I think you have a real edge in winning a deal, in adding value to a deal, and having better insight in whatever it is that you're doing by having specialization. And I think that's just a common theme that I see across the board. And that's been I think an evolution and shift and focus of ours as a firm. So great to be with everybody.
Good to see you again. Let's catch up. Sorry, Sean, I was buying you time for that, so you could. But
all right, let me pull
not
it back
that you're
up.
a time buyer, Brian. I did want to hear from you, so I'm glad.
All right. Okay, well, Mark, maybe I'll just start with when we talked. One of the things you were asking about is, you know, what are you talking to clients and prospects about? And this summer we had a family that we work with. The principal came to us and said, you know, really what he was looking for is something different, something outside of sort of the index exposures. When you think of, you know, what was working, Microsoft, Amazon, you know, sort of those names, and a portfolio that, you know, didn't have that exposure, but would complement, you know, those types of exposures. And as a firm, we manage multiple strategies, and our thought was, okay, let's take a look across all of the different strategies we have and put together a portfolio of sort of best ideas that help out with this idea of being a complement to core holdings. And we started this portfolio sort of late summer, towards the end of August. And you know, I thought I'd just share with you some of the things we're looking at. You know, we've got some exposure to the communications sector. You're seeing some broadband plays there, which we think are going to be extremely important as we go forward with the work from home or a more remote sort of workforce. Broadband is going to be extremely important. We think it's going to be very important with 5G as a potential as a backhauler of data. You got some spectrum plays in there. As you know, we just had the government auction of the C-band auction, which the numbers should be out soon, but I think the estimates are about $80 billion were spent in the auction. You look at Dish, it's a company trading in the 30s. If you look at their spectrum, you know, on a valuation basis, we can get to a $75 price targets purely on their spectrum. So, you know, some interesting things going on there. The industrials, it's more of a defense play. You know, Raytheon's a company that their defense business is is fantastic. They've taken a bit of a hit, obviously, from the commercial side of the house that we think is, Greg was talking earlier, as we start to see open up the economy, we imagine the commercial side of the business starts to gain some traction on that front. Materials, I saw infrastructure up there, I think on Bill's slide. If you're thinking of an infrastructure plan coming out, Mesabi is an interesting opportunity. This is a royalty pass-through on a iron ore mine that was purchased. They don't own it, they just collect the royalties. It was purchased by Cleveland Cliffs, which has been on a bit of an acquisition spree. They're vertically integrated now. And if you look at iron ore prices, which is really the basis of their royalty stream, they've been extremely strong. We think we probably get about a 15% distribution yield in the upcoming quarter. So Mesabi's interesting play in the infrastructure space. MP Materials we've talked about, I think on Mark's calls in the past. This is a rare earths play. It's the old Mountain Pass mine. Right now you got 90% of rare earths being produced out of China. This is an opportunity, really a strategic asset. Right now, they're just a miner. That eventually, phase 2, there'll be a refiner, and phase 3, there'll actually be a manufacturer of magnets, which again are critical to sort of the green energy space and certainly EVs. Just moving forward in this consumer discretionary, we've got sort of a special situation in there with Drive Shack. Here's a company that's really transformed. This, you might remember, it's the chairman of the company is Wes Edens, the former founder of Fortress Investment. But this was basically a real estate, a REIT of golf courses, and they had some development opportunities as well. Wes sort of just turned to business and sold off most of the property, stopped the development arm of the business, and really, paid down an awful lot of debt. And we're investing through a 9% coupon perpetual preferred, which we think they're either going to call or certainly start to pay again. They run the risk of losing 2 board seats, which we don't think Wes is going to allow happen. They just issued some common. We think it's probably going to pay down the preferred here.
It's unfair. I gave you you need 40 minutes, but I just want to get a flavor for some of the things you're thinking about.
Yeah, if I could just add one thing real quick, Mark. Greg was talking earlier about sort of the rotation out of sort of these high valuation stocks, and we would agree totally. But as you get into technology, there's still a lot of value out there, and be happy to talk to anybody offline about some of the tech names, which we think are offering an awful lot of value.
Great. Anyone else want to chime in on that or otherwise?
Hey, Mark, I had a quick question for any of the Asia participants. We have a couple of portfolio companies in Southeast Asia I'm on the board of in the food sector. Just out of curiosity, maybe Rob or Neil, the fact that the U.S. is going more towards, in COVID, towards nearshoring or onshoring of the supply chain, is that going to give you more access to some of the better, pharmaceuticals or supply chain benefits there coming from China or India? Do you have an opinion on that?
Sorry, I didn't catch the middle part of that. I picked up on agriculture and then.
No, it's not agriculture. It's just more like on either COVID or other supply chain benefits, because the U.S. is going to be looking at more nearshoring or onshoring of manufacturing. So I think you're going to have some better access towards some of the better products from China, India, etc.
I mean, I don't have a particular view on it. I've had a few discussions with a couple of folks who are trying to, execute strategies to invest in manufacturing in the US. They see a long-term opportunity there, and a long-term demand driver for products out of the US. Whether that means that there'll be better access to products for us here, I don't know. I mean, I think that's a pretty sort of macro governmental debate that's going on, and there's obviously been the debates around the Eurozone trying to play diplomacy with its medical supplies into Africa and prevent Russia and China creating diplomatic channels through that. But I mean, that's certainly something that I don't really have a particular view on. I don't know if Neil, you have a view on it.
If I may.
No, I'm sorry. It's not really a place that we play in. Sorry about that.
Sherry, you have a comment?
No, so if I could piggyback on the Asia questions, there's two questions that I have. So I've recently come across some really amazing traders from Singapore. And what I didn't realize is that in Singapore, the short-term trades are deemed speculative. And so you guys don't have short-term cap gains. So I found some really interesting traders that play in that space. So as someone who was born and raised in New York City and an American citizen, short-term cap gains for me is taxed at a 2/3 rate. So if anyone knows any other traders in Singapore, I'd love to hear about them. And then the second question is also for the Asia guys, is there an SEC protected way for an American citizen to play liquids in China, in the China market? So can we capture, as an American, can we capture the growth of the liquid Chinese companies but maintain the protections of a US citizen that you would have, for an SEC compliant product?
As a non-American, I'm going to plead the fifth on that. But I'm sure there's people that I know who are better versed to advise you on that, who I'm happy to connect you with. And certainly I know a couple of folks running interesting liquid strategies out of Singapore, so I'm happy to connect and put you in touch with them as well.
Thank you.
And I'm sure that you could pick up on that tomorrow if you come, Sherry, or 8 o'clock.
Thank you, Mark.